What is inflation? Inflation is the rate at which the general levels of prices for goods and services rises, leading to a decrease in the purchasing power of money. In simpler terms, it means that over time, the same amount of money buys fewer goods and services than it did before. For example, let's say you live in a country where the inflation rate is 5% per year. If the price of a loaf of bread is $2 at the beginning of the year, with 5% inflation, by the end of the year, the same loaf of bread would cost $2.10. This means you would need to spend more money to buy the same amount of goods, indicating a decrease in the purchasing power of your money. It's a natural part of healthy economic growth, but can become problematic if it occurs too rapidly or if it's too high. There are various causes of inflation. Demand pull inflation. This occurs when demand for goods and services exceeds their supply. As demand outpaces supply, sellers may raise prices to maximize profits. During the holiday season, the demand for toys exceeds supply, leading to price increases as retailers try to meet consumer demand. Cost push inflation. When the production costs of goods and services increase, such as due to rising wages or raw material prices, producers often pass on these higher costs to consumers in the form of higher prices. A surge in oil prices leads to higher transportation costs for businesses. To maintain profitability, these businesses increase prices for their goods and services, causing inflation across various sectors of the economy. Built-in inflation, also known as wage price inflation. This occurs when businesses raise prices to cover increased labor costs, and workers demand higher wages to cope with the increased cost of living. This creates a cycle of rising wages and prices. Monetary inflation. Monetary inflation occurs when there is an increase in the money supply in the economy that is not matched by an increase in the production of goods and services. This can happen due to expansionary monetary policies by central banks, such as lowering interest rates or quantitative easing. Expectations. Inflation expectations can also contribute to actual inflation. If individuals and businesses expect prices to rise in the future, they may adjust their behavior by demanding higher wages or raising prices, which can lead to a self-fulfilling prophecy of inflation. Exchange rate changes. Inflation can also be influenced by changes in exchange rates. If a country's currency depreciates relative to other currencies, it can lead to higher import prices, which can then spill over into higher domestic prices. Types of inflation by speed and intensity. Creeping and moderate inflation. Creeping inflation refers to a gradual and steady increase in prices over time. It's typically low enough, 1 to 3%, not to cause significant economic disruptions, but can still erode purchasing power over the long term if wages don't keep pace with rising prices. Walking inflation. In this case, the inflation rate falls between 3% to 10%. Such inflation can be harmful to the economy. Consumers start stocking goods fearing the prices will rise further. This causes excess demand and the prices increase further. Galloping inflation. Galloping inflation is characterized by a much higher rate of inflation, 10 to 50%, prices rise at a double-digit or even triple-digit percentage rate annually, leading to significant decreases in the value of money and uncertainty in the economy. Hyperinflation. Hyperinflation is an extreme form of inflation characterized by rapid and uncontrollable price increases, 50 to 1,000% or more. It typically occurs when a country's monetary system collapses due to excessive money printing, loss of confidence in the currency, or economic instability. Examples include the hyperinflation episodes in Zimbabwe and Weimar Germany. In Zimbabwe, in the late 2000s, hyperinflation reached astronomical levels, with prices doubling every few hours. Citizens experienced a complete loss of confidence in the currency, resorting to bartering or using foreign currencies for transactions. Other types of inflation. Open inflation. Open inflation refers to a situation where prices are rising visibly, and the government takes no action to control it. It's essentially inflation without any efforts to curb or manage it, often leading to rapid increases in prices and the loss of confidence in the currency. Repressed inflation. Repressed inflation occurs when the government artificially suppresses inflation through price controls, subsidies, or other measures. While this may temporarily keep prices low, it can create imbalances in the economy and lead to pent-up inflationary pressures that can erupt once the controls are lifted. Example: a government imposes price controls on essential goods such as food and fuel to keep prices artificially low. While consumers benefit from lower prices in the short term, this can lead to shortages, black markets, and eventual price spikes once the controls are lifted. Semi-inflation. Semi-inflation is a term that describes a situation where prices are rising, but not across all sectors of the economy uniformly. It implies that inflationary pressures are present but are concentrated in specific industries or regions, rather than being widespread throughout the economy. Example: while overall inflation remains low, the healthcare sector experiences significant price increases due to rising medical costs and insurance premiums, causing healthcare services to become less affordable for many people, while other sectors remain relatively stable. Imported inflation. Imported inflation occurs when domestic prices rise due to an increase in the cost of imported goods and services. This can happen when a country relies heavily on imports and experiences a depreciation of its currency relative to other currencies. True inflation. True inflation is a term sometimes used to differentiate between the official inflation rate reported by governments and the actual increase in the cost of living experienced by individuals. It suggests that official inflation figures may not fully reflect the price increases faced by consumers, especially if certain costs like housing or healthcare are excluded from inflation calculations. Inflation impacts nearly every aspect of our lives. It reduces the value of savings, decreases purchasing power, and can distort economic decision-making. Inflation may seem like a complex topic, but it's crucial to understand its different types and implications. If you found this video helpful, don't forget to like, share, and subscribe for more content. Until next time, take care and goodbye.